What's up, outliers? Happy Friday. Welcome to Beginners Options Trading, or Options Trading for Beginners. However you like to frame it, I don't really care. Whatever works for you works for me. Now, the goal for the stream today is to take a closer look at some of the very specific ways options make money, how you can actually generate profit with options. Now, I'm going to provide a super quick overview of the more high-level topics. Most of you kind of people that are doing these streams for a while, you'll be familiar with this stuff. And then for the rest of the group, I want to actually click into some less respected elements of how options generate profit and get a little more nuanced and work through a couple examples that I actually think most of you will be unfamiliar with. So let's start with the easy stuff. Let's start with the ways that, again, most of the regulars will know how options generate profit. And then if there is anybody in the stream that's not a regular, do not be afraid to speak up and say, I have a question, or I don't know. These streams are designed to be entirely interactive. That's why it's a stream. So let's start with the way options make money. Let's start with a simple comparison. This will probably be useful for most people. Create a benchmark. We have equities, and then we have options. Let's talk about the way that these make money. We'll start with equities. They make money from direction, up or down, and then yield. Now, you can argue that there's a couple other things in here that I would give grace to, but these are really the main things that ultimately drive your P&L if you're holding some sort of equity. Now, also within direction, I include things like stock buybacks, because it's kind of the same thing as a dividend. It's a way to pay your shareholders. But with a stock buyback, the way that that's manifested is through direction. So same. Now, for options, we maintain the same idea of direction. We actually strip away yield. You don't get a yield anymore. And now we have a couple other elements that are exclusive to the option side of the equation. We have time, we have volatility. This also can be broken down into more sub-relationships and stuff, and I would, again, have some grace for some other things that we could add to this. But these really are the main mechanisms that we're talking about with equities and options. Now, when we're talking about equities versus options, we, as we know, go from here, which is less complex, to more. And I think everybody kind of knows and respects that. When we're talking about this additional complexity, not only are there new factors, there's also, among those factors, factor relationships, language, operations. When I say operations, I mean the actual movement of options, how exchanges move your orders through their pipeline, how you submit orders, those kinds of things. So we're increasing complexity here. There needs to be a reason why we would accept more complexity. Nobody would take this decision and say, based on these factors alone and adding this layer of complexity, in preference of this. So there's a big difference that options provide that equities don't, at least in the same context, which is leverage. And these bubble up to profiting from non-delta factors. That's a huge difference. So with options, you are not slaved to the primary way you make money with equities, which is direction. Even if you have an equity that pays a yield, more often than not, you will make more money on price appreciation of most commensurate tickers than anything else. That's not to say there's no use case for yield. There absolutely is. I'm actually in the process of reconfiguring part of my portfolio for exposure to qualified yields, which is a whole other purpose for that. So this isn't saying this is bad, but this is saying that most of the money that you're going to make in equities is from this bucket versus this bucket. So we have a sense now from a fundamental layer how options generate P&L, literally from this side of the equation. Now, what's typically useful is to take a look at an example. So we'll start with SPY just because we have SPY up. I'm actually going to go into on demand. And I want to work through a quick example live. And then after we get through this layer, I want to talk about one other thing most of you will be aware of, and then I'll pivot to what I consider to be the cooler stuff that, again, my genuine expectation is most of you won't know some of the stuff that we're going to cover. So let's start with the easy stuff. I'm going to go back in time. I'm going to take us to 24 June, and we're just going to play this to the upside. We're going to play S&P to the upside, just so that we can see how a strategy might behave. And what you'll notice is that based on what you set up, as price is moving, you'll obviously observe a different modality in terms of P&L. So let's go to June. I think I said 24 June here. And I'm going to show you 3 examples really quick. And it's so that you can get a sense of different relationships. And let me get a trade log set up. This one will do. I'm actually going to condense this down so it's less in the way. And I'm just going to fill this in really fast as we look through this. So today in the example is 24 June. The ticker that we're looking at is SPY. And we're going to look at 3 variations. We're going to look at equity. We're going to look at long call. We're going to look at short put, maybe 4 variations. We could do like a synthetic long. We'll just do those 3. We won't get carried away, Eric. My natural lean is as I do different exercises, I like to be a little bit more encompassing, but such is life. So we'll start with 100 shares. And what I'm doing over here so that you can see is I'm literally just inputting my log. Now, we need to normalize the size of these different positions. So in this context, we have 605 is the price and 100 lots. In this case, 100 shares. So we need to multiply these to figure out what the size is that we're working with. In this case, it's 60,568. So this is going to allow me to structure the other trades to be commensurate size so that we can see how they perform. So we'll do the 52 days. Again, just kind of picking stuff, not trying to be optimized. I'm going to do the 605 short put. So in this case, we're going to have one of the 15 AUG. And this one's just going to be a short put. Our strike is the 605. Delta is, I think, a 0.44, if I'm not mistaken. And then you'll notice the way that I have this log set up is as I have logic built into this column so that it knows what the position is based on the logical flow of what inputs I give it and what those inputs look like. So you can see it knows inherently that this is a stock position because there's no expiration, and it's accurately classifying it as an equity. This one is obviously being accurately classified as a short put. The reason why this matters is because from a logging perspective, we want to be able to isolate the different things that we're doing. so that we can test efficacy. Okay, so the next thing I'm going to do is we're going to simulate buying. So we're going to get one of the same expiration, 15 AUG. And in this case, we're going to do a long call. Long call is going to be 610 strike. We're going to get that for 51 deltas. And we are going to pay 13.16. And then I think that's that's putting me at the offer. So we'll sell at the bid on the put side. So 11.69. Cool. So we have our initial look at these positions, but again, as we know, these are nowhere near scaled appropriately. Now the formatting of this got a little messed up, moving it over. The way I typically format this is that if it's a positive number, then the premium is positive. It's a negative number, it would be green. And then if it's a negative number, it would be red. So in this case, the price that we're getting it for is 605.68. And this one also needs to be a negative because we're buying it. So you can see that it calculates my cost automatically. And again, just to give you a sense from a logging perspective, so you understand what this typically would look like, essentially would set it up so that if it's greater than 0, I normally don't do this highlight, normally just do the number, which is great. And then we'll add one other rule, which in this case, it will be less than 0. And then again, in this context, I would just do. So then it makes it pretty easy for the eyeball to track. Cool. So we have our 3 positions on. Let's fast forward time. And again, I'm going to scale these so that these are appropriate. So the way that I would scale them is I'm literally just going to take the cost divided by what the margin requirement would be for this, which we can estimate, and then divided by the cost for this. So in this case, we get 46 contracts from here. That puts us right around same ballpark. And then again, like I said, for this one, we would have to estimate what the margin requirement is. I don't know what regulation T asks for. So let's see what this says. 1169. I don't think that's accurate, because that's literally just the profit. I don't know. Could one of you guys do me a huge favor really quick? Could you let me know what regulation T is asking you for if you wanted to sell a put in SPY? It doesn't have to be super accurate. I just don't want to give you something that's like way off, because again, my accounts, their portfolio margin. So the stuff that I have to put up is way less. To give you a context of what that number looks like, I can let you know. But recess for buying options, no margin. Yeah, no shit, Sherlock. I'm talking about selling the put. Let's take a look at SPY really fast. So if I look at selling about a 40-day option in SPY with portfolio margin, it's asking for 1,000. Reese says 30% for Reg T. Is that correct? Regulation T margin requirement. Let's see. Gemini is thinking. Sometimes I find when you put like simple questions like that into an AI, it literally takes longer. So anyways, for portfolio margin, it's literally asking for $1,000. So my guess is it would be a bit more. Let's see. Okay, so standard is 50% initial, 25% maintenance is what it's saying currently for like ETFs. And then what does it say for, okay, so it says 25%. So this is 60,000. So 15 grand. I was going to guess 12. So close enough. So 15 grand. That gives us 4. So we get 4 of these. And then again, just for the sake of the example, I'm going to add another one down here that's actually using portfolio margin. So then the portfolio margin variant would be this divided by, we'll just call it like 1050, 58. You get 58 of these with PM. Okay. So now we have just pretty even comparison across the board. Reese says for shares, I get no margin help. Well, you do with shares, but it's different. There's a big difference between trading with margin and trading on margin. So trading with margin in options markets is trading with margin. It's when you essentially get an accommodating size relative to what the actual capital requirement is. And that'll differ between, regulation T and portfolio margin. Now, for equities, you absolutely can trade on margin, which is when you borrow money to put on a bigger position than your cash and sweep can handle. Reese says, I get margin on shares, not on short puts. They need full cash. Yeah, so in your account with obviously whatever tier setting you have, they're forcing you to cash secure your puts. So that's almost always, it's always going to be the case in retirement accounts. And then depending on your broker, they effectively ask you to take, I actually don't even know if they make you take tests anymore to up your tier, but they definitely make you take a test for portfolio margin. I imagine that they still make you do that. All right, so let's fast forward time really fast. I'm going to give us, that's 1, 2, 3, 4 weeks. I'm going to move us a month. And then we're just going to mark these all at the end of the month just to see how they did. So the first thing I want you to observe here is literally just how these different positions behaved and made money over the course of this month. So in this case, we're now at 627. And all I'm going to do is look through and see how each of these behaved for us. We're going to pretend we're going to close them. So in this case, the equity position is really, really easy. We're just going to sell that to close. So we're going to get out at 627.73. So we have our return on capital. To give you the metrics over here, let me expand these slightly just so that they're not super crunchy. There you go. So in this position, we made 2,200 bucks. We put up 60 grand. The stock moved over that time. I'll actually put in the real number since I already had to for this. This way you can just see what the actual return was, which is 3.64%. And the reason why there's no ROIC calculation right now is just because we need to include the cost for this. So in this case, it's 60,568. In this case, we said, let's just call this one 60. This one is 65 through 6. And then this one is also 60, but this one is for, again, portfolio margin. So this one will actually have a much, much better return on invested capital. Okay, so now we'll take a look at what our put is trading for. We simulated the 15 AUG, which we're still in there, and we simulated the 605. So we're going to close this put for $2.96. I'm just transacting at the bid and the offer. Mine is 2.96. So in this case, we made way more money than holding the equity on the short put. That is way more money on the short put than the equity. I think I might have flipped it when I said I'm not sure. This is really, really, really important to understand this relationship deeply. Because when we're talking about how things make money and how options make money, This becomes one of the most important aspects to this conversation, which is understanding based on what you expect to occur, what your hypothesis is, what position makes the most sense. In this case, you can see that even on a Reg T margin account, you made more money on these short puts than you did buying and holding the commensurate sized equity position. This is not always the case. There will be plenty of instances where realistically this is not the case. So understanding what happened in this case that led to this, that becomes a factor in your decision-making process on when you might choose, again, to structure your position, in this case, a long hypothesis via a short put, via the long stock. Now, let's take a look at this long call. We had the 610s. So those 610s are now trading. We're going to sell them for $23.34. And notice how the overall profit here is a little bit different. This is just because of the slightly different sizing between portfolio margin and the long calls. But the long calls are accessible to everybody. And take a look at how the long calls did compared to the commensurate size positions up here, again, for like a regulation T account. The long calls murdered everything. So this is an instance where, again, as I will always mention, if you actually understand options and you understand how they make money, you can naturally go into this very scenario and know which of these is going to make you more money. We can take this a step further. For example, if I wanted to tinker with different deltas on my short puts or different deltas on my long calls, that opens up the next tier in your analysis here. Because for most people, they sell 30 delta puts to start. That's fine. What's the downside to a 30 delta put? The 30 delta put typically underperforms buy and hold equivalent for moves that is equity moves that essentially exceed a certain percentage depending on what vol is. But typically 2%, 2.5%, you'd make better off on the equity than a 30 delta put. But that doesn't mean that you can't up your deltas if you want to sell an option and you're still really bullish. You can also go in the money and sell a put. A lot of people don't do that if they're really bullish, but sometimes that can be a better trade because it still builds in a buffer. So I want to show you that really quick. So let's say from this point in the experiment going forward, which is 22 July in this year, and let's say that we think SPY is going to go up again. And in this previous move, would we go from 605 to 27, so about 20 points? So let's say that we think it might have a commensurate move in and we want to take it and sell these. These are still only like a 50 delta. So we want to sell these 640s. These are a 61 delta. These are in the money. We analyze this trade, and I think, I don't know how it works. Is this correct? 20 sep there. What does this have? This has 5 sep. So we want this to be 22 July. So that it'll look correct. So one of the things I want you to notice is spot price in this example is 627 here. Notice how when you sell this in the money short put, you still get a buffer to the downside. So you can still be wrong by several points and still make money. Now you're not going to make a bunch of money. And in this case, because we're selling in the money, you need it to go up in order to hit your max profit. But in this case, you're going to make even better money than this scenario. Now, again, this is all in hindsight, right? This is all super clear. We know, most of us know these concepts, I imagine. But this opens up a really important decision-making process with respect to, do I want to buy options? Do I want to sell options? Do I want to trade options where I am collecting premium and I think it's going to move a certain amount, within a generally tight range? Or do I think it's going to exceed that amount and it might move more? The cool part is you can make a logical decision every single time based on this. Oh, and also fun fact, they give you regulation T margin in here. So this is asking for 14 grand versus 15. Anyways, so let's take a look at a position really fast. And this will be default buy 100 shares. And again, if we buy 100 shares in this scenario, it's saying 31 grand. That I don't know why it's saying 31 grand. 627.73. How's it getting to? I'm just curious at this point how it's getting to 31 grand. Anyways, like 50, 50%. So this is only asking for 50%. I don't know why, but in this context, it would be 62 grand. So what I'm going to do is size this again so that they're the same. It's important to have these commensurate sized. So for us to get there, we'll probably need, clicked the wrong one. For spot price, that puts us at 4 again. 57 is close enough. So what I want to show you is a way for you to logically compare these based on what you expect to happen. Now, you can always use the options markets to determine what you think might happen. You might look at probability of touches at different price levels. But in this case, we could just look at this and we can say we think it's going to go to, let's just say 635. That's our near-term target over the life cycle of this trade. We think it'll get to 635. Which one of these does better at 635 if it gets there? Well, we can literally test. So in this case, we're just going to input a target of 635. We're going to lock that price. We're going to see what our P&L would be at that price. We make $1,600 on this position being the short puts. If I look at this position, you make 727. So which of these makes more money? Again, the short puts. So then we can subsequently say to ourselves, where does this become the opposite? Well, that's super simple because you know what your max profit is capped out in this trade. Your max profit at expiration is capped out at 73.92. So you can literally see where is 73.92. And that's the point that you would need SPY to be in order to outperform those puts. So in this case, that puts us, damn it. Kind of like a fun little game. Fuck it. That's as good as it got. 702. $702. That's where the long stock would need to be to outperform those short puts. So then from there, I can attach a probability to it. I could say, what's the probability of us hitting 702 over the life cycle of this 19 SEP trade? So I can go to 19 SEP. I can find a strike closest to 7 and 702. In this case, it's between these two, so I can interpolate a little bit. And I can say, what's the probability of a touch? 11.5% 2.58% probability of a touch and a 2%. So call it 2.25. There's a 2.25% chance that S&P touches this level before expiration versus what I might be able to make if I expect anything within that move on the short puts. That is a holistic trading decision cycle between these before we integrate what I want to talk about next, which is volatility. I'm going to take a pause here and see if there's any questions on what we talked about specifically in comparing the profit mechanisms that we looked at, this case, price direction up, but then seeing and learning how to compare the profitability of different types of positions designed to capture that profit mechanism. And again, in this case, we're talking price direction up. If you have any questions about what we did there, now's the perfect time to ask. While you're thinking, I want to talk about another concept really, really fast, which is notice how I integrated the topic of profit mechanisms. at the end of the day, it does not matter if I had picked the short put, if I had picked the long equity, if I had picked the long calls. It doesn't matter which of those I picked if I picked it here and then it subsequently crashed. Doesn't matter what I picked. I'm wrong. So this is why I talk so much about the concept of profit mechanisms. And I literally have a video on this exact topic. I think it's called How to Actually Make Money in Trading. Let me see really quick. I don't think it was that long ago that I put it out. I think this one. This video. So that video is called like what actually matters in options trading. And it talks about this exact topic because it actually matters. Now, I don't see any questions. So I want to move on to a slightly more nuanced topic that I actually think is a little bit more fun. And I want to start with a quiz for you guys. So let me go, and I want to go back to like September. I'm just picking a random, generally random time for most people. September 3rd. And I'm going to go to a stock, APP. Literally just doing a case study on this not all that long ago. So what I want to do here is actually use this for you guys as an exercise. Based on where you see APP, you know me, APP here, what kind of trade do you want to make in here? And based on what kind of trade that you would like to make in here, I want to set up a couple of them based on, again, whatever you want. Reese says I can't see price if it matters. It doesn't. But just for context, price is at the 90 handle. So current price here is at 90. But what I want is you guys to throw in the chat, what kind of trades do you want to put on in here based on just what you see? It doesn't have to be super specific. It could just be short puts, long calls, synthetic long, iron condor, whatever makes you happy. Lauren says up. So it's a good guess. So based on up, what kind of position? Okay, so Reese says short puts. So we'll throw on some short puts really fast. I'm just going to go out 45 days. Lauren says long calls. Great. We'll do that too. So we'll add the puts here first. Then we'll add the long calls. I'm going to grab those, just grab something that's at the money. I'm just picking the same expiration for simplicity. BRB says long delta 70, 45 days out. Okay, we'll add one more. So this will be the 75. I see 70 deltas here, so we'll grab those. Okay, great. So what I'm going to do is fast forward time really fast. And I just want to, again, give you guys an idea of how this thing might behave. Lauren says, in my defense, I know nothing about this stock. That's great. You're not supposed to. It's supposed to be somewhat random. So I'm going to fast forward a month. So that's going to put us here. We're going to go to 1 October. And then we're going to compare the P&L of these different trades. And again, okay, so this is blast off. This is, and for those that don't know, this is actually one of those periods that I was trading APP. And if you go back through the archives, you'll know exactly what kind of positions I chose for this scenario. But mine was a few different things. So if we take a look, Mikhail says 16 Delta Strangle. 16 Delta Strangle would have gotten ran over. So be thankful that you didn't have that on. And let's take a look at these positions really quick. So I'm going to go into here. So to start with the 85 calls, which was the 70 delta equivalent, they're now running for 45 bucks. We got those 85s for 920. So the P&L on those 45.10 minus 9.2 is 35.90. So that trade went on for about 900 bucks and you're getting 35.90 back. The next trade that we'll look at is the 90 calls. We got those for 610. Those 90 calls are now going for 40. Those calls made 33.90. You put up 610 bucks. So really, really good return on invested capital. And now the short put obviously will have made 460 bucks. So this is a really good case study of what we just looked at and how these different things might behave as the underlying hopefully goes in the favor that you would like to see. Now, the other part of this equation is how do they perform when they're losing, and how do you pick based on a downside risk profile, which is the scope for another video. Okay. Now, the last thing that I want to show you guys before we wrap up is actually based on an earnings cycle. I want to give you a deeper look into how volatility can impact the P&L of an options trade, which I typically believe is not well understood. So once we get unfrozen here, there we go. I want to go back, and we'll go back to this earnings release here. The 7th of May, we'll just stay in APP because we're in it. The first thing I want to do is I want to go back here to 23 April, and I want to play into this 7 May earnings release. So I'm just going to take a couple notes. So APP, it has earnings on 7 May. And let's see when those earnings were after the close. So 7 May PM. Cool. So we can get rid of all this stuff. And I want to go back now to 23 April to start our first series of trades. April 23. I'm just going to go to, 23 is fine. And I want to work through an example. Now, let's take a look at how volatility behaves and how volatility can impact the P&L of your position. And I want to give you a few different examples to look at for this. So again, we know earnings is on 7 May. So I'm going to use this expiration cycle, the 9 May. And coming into this earnings release, the first thing I want to do is look at buying a straddle. So if we look at buying a straddle, I'm going to move this off to the side. So we have 23 April. And the ticker is APP. And the current price is $258.18. And we're just going to look at a one lot. Expiration is going to be 9 May. So this is going to be a short duration trade. And we're going to have long calls and puts effectively at the same strike. Actually, the at the money is here, believe it or not. This is a 44 delta against a 54, but I see the closest straddle, like the at the money in terms of deltas, is here. So we'll use this one. We're going to do the 270. And on the call side, our delta is 0.5. And then our long put is also at the 270. And then our delta here is 0.5. Okay. So our premium here is going to be negative 62.10. What I want to do is carefully track the vols for these. So the implied vol for this one is 131.77. And then our vol for this one is 134.67. And these are percentage. Now, the other thing that I want to track for us is our vega. I throw our vega up above just so that we have that. Or theta and vega, actually. So I'm going to have theta here and then vega here. And then again, I'll show you what I'm doing in the log so that you can follow along. Our theta is negative 0.883. And then our vega is 0.22. And then I'm going to do the same for the puts. What we'll be able to do then is to summarize these into a composite, theta and vega. So our theta on this side is also negative 0.88. And then our vega on this side is also negative 0.22, about 221, about as clean as you can get. So now what I'm going to do is I'm going to include a composite theta and vega. Our total theta is negative 0.1763. And then our total vega is 0.442. Great. So now I'm going to fast forward. I'm going to fast forward not as far. We'll do a couple days first. And I want to show you how this behaves over that couple days. So the trade entry here was 23 April. And then now we're looking at 25 April. What I'm doing is I'm going to create like a small little table for us to be able to look at together. Okay. So now our theta on, well, first let's just take a look at the overall P&L. Our overall P&L, we got it for 62.10. Right now it's at 60.50. So I'm actually going to add a premium column to these so that we can track that as well. And our original was 62. So now on 25 April, our premium is negative 60.50. This is for the composite. I don't care about the premium for the individual options. That's less purposeful to me. I do care about the premium, or I do care about the individual Greek. So the individual Greeks here now are negative 1.02. And then vega is negative 0.22 still. And then we'll do this one more time. The put side, theta is now negative 0.99. And our vega is 0.22. Let's take a look at the vols now for these options because we do care about the IV. So the IV from the start on the puts was 131.77%. On the calls. And then now for those calls, it's 136.85%. And for the puts, starting was 134.67%. And then today, those are at 136.57%. So let's take a look at what's happened so far. What's happened so far is really important. What's happened so far is, I got a warning for Thinkorswim. What's happened so far is 2 days have passed. Over the course of those 2 days, our theta has come up by like 20 cents. Our total theta, which is minus 210. Our Vega is at 0.44. If we take a look at the change in total vol, the change in total vol, like if I were to calculate a total vol metric, I'll just put that here. And I'm going to do it for both time frames. So we have 236% vol there. 273 vol there. So it's essentially a 7% change in vol. And most of that came from the call side. So if we look at this against our Vega, which is essentially 7, I'm just going to do the math hard so that it doesn't apply the percentage. Times our Vega. We got 3.1 on our premium. Now, if we take a look at the change in our theta, which realistically speaking, if I wanted to do this a little bit more accurately, what I would do is take this plus this, divide that by 2. So it kind of gives me a linear slope between these. It's not exactly correct, but it's close enough for this. And then we passed 2 days. So are we surprised that we've lost a little money on this position so far? No. Why is that? Because volatility has not changed enough. So I'm going to fast forward just one more time, and then I want to show you after the earnings release with short vol for the series of examples. I'm going to give us, let's just go 2 earnings, because it was, what did I say, after the close on the 7th? So we'll literally go to the 7th now and see how all this looks. So this is now 7 May for our next example. These I'm going to move off to the side. And actually what I'll do is slide all these like down 1 so that we can track our composite IV here. This way we can track the differences a little better. We can get rid of these now. Okay. So now on 7 May, let's take a look at the metrics really fast, shall we? We're now at 56.2. Oops. And I want to show you effectively what's happened during this trade. This is breaking down, again, the details of how options actually make money. That's the entire purpose. So the theta now, we're at the 270s. This is without doing any sort of rebalancing, which, by the way, if you're long a straddle like this, you would need to rebalance, but we're just assuming no rebalancing. So our theta on these is now negative 4.2. Our vega is 0.09. And our IV is 245.4%. Now let's take a look at our puts. Puts theta, which we're looking at here now. Theta on our puts is negative 4.26. Vega is 0.09. And then implied vol 249.9%. Okay. So now we can take a look at all of our composite metrics. Oh, because this is go. Okay. So let's see what's happened here. And I'll actually take all this. We'll go over here so that we can find a blank spot and actually take a look at these a little more in depth. So these are calls, they're puts. This is the position. Okay. So over the course of these days, if we plot these, see how well plot these for us. We're definitely going to have to do 2 axes. And we're going to have to put IV on its own axis. Except it's not a sec. 363 is headers. No, we definitely don't want. Column L is labels, that's right. No, that's not right. We want those as series. Yeah, this is more correct. And then now we just need to update the series. So in this case, we need IV. This one will be the right axis. Then I don't know. What is this one? Position. Oh, that's why. Just this one. There we go. And now all is clear. Cool. So here's essentially what's happened over the life cycle of this trade. Now, in this case, don't let the premium, I'm going to get rid of the negatives just so that it's not confusing you, misleading you. So the premium is actually contracting here. So if we look at from start to finish, what's happened to our premium? It's gone down 5.9 points. If we take a look at something like a change in vol has gone up a lot. It's essentially gone up 229. So then if there's that big of a change in vol, why wouldn't this have shown a better outing? Well, a lot of that is tied into this unfortunate red line. And again, for this one, I'm going to get rid of the negative. These will be absolute, just for this example, because I want the lines to logically flow. There you go. So notice how over the course of this trade, how much these have moved. So what I'm gonna do, I'm actually curious, what happens if this is on, that's on the left axis. I'll put the premium on the right axis. There we go. It'll just give us a little bit more life, this data. So if we look at the change in theta, notice theta's slope compared to implied volatility slope. What do you notice here? Mikhail says, what do you, when you say rebalancing, you mean recentering? Yeah, exactly. So just maintaining, I don't think of it in terms of centering, because sometimes people would misconstrue that as go to at the money, but that's not actually what I'm doing. So when I'm talking about rebalancing, I'm specifically talking about making sure that the deltas of the position are what I want. And for a straddle, I would want the deltas to be about flat. So in this case, I can see I have 30 deltas from this side and 70 deltas from this side. So I'm going to be net long 40 deltas, which I don't want. In this context, I would want to be flat. So that's why I specifically refer to it as rebalancing, not recentering. Because in order to get this position rebalanced, I actually would not go to the 297.5. Because if I do that, I have a 54 delta here and a 46 delta here. So I'm actually still going to be net long deltas that I don't want. So in order for me to actually be rebalanced, I have to go here to the 305s. Because at the 305s, I have 50 long deltas here, 50 short deltas here. We net those deltas out. In this case, I'm actually flat deltas, which in this scenario, that's more what I would want. Because the goal in this example is showing you the impact of the changes in premium from something like comparing theta, which is here, against vega, which is here. Because if I add another line here and we look at like total position theta versus vega, there's a really important change that's happening. Is notice how our vega is actually going down. So even though our IV change is exponentially going up and right, our price sensitivity to that change is actually going down. So this really mutes what might seem to be a huge change in vol. 229% change in vol seems like a really big change. It's not insignificant. However, that change is facing a key headwind. that key headwind, is that your Vega is actually slowing down as you get closer to expiration, and your theta is rapidly accelerating as you get closer to expiration. So I want to give you a demonstration of how powerful this effect is. So let's say instead of your vol effectively doubling, your vol didn't double. Let's say that your vol was at, let's do like total Vega impact. So the way that we'll do that is essentially taking this times 100. You need to do the IV times 100 to take it out of the percent so that you can actually do the math for this. Times your Vega. This, wait, what did this put as? Way too many. 67. Is that correct? Double check it really quick. No, it should be 117. So one of these. Oh, it like changed to summing for some. I want this specifically. Guy. I want this times 100. And then I want this times this number. Yeah, that's better. So this becomes our actual P&L impact. Now, if we take a look at that corresponding with theta, and you'll see that even though that there's a big impact here, theta literally expands almost 8-fold. So as your P&L Vega is decreasing, even though it's getting to the steepest growth phase, you're not outpacing on your theta. So this is a great example where you might actually see what you're hoping to see, which is a really big change in IV coming into earnings, which you objectively saw here. But even though that big change happened, it still wasn't enough to outpace your Vega. So when we're getting into the weeds of how options actually make money, this is the detail that you need to understand. Because without a deeper understanding of how these different factors impact your position, you might inaccurately say something like, oh, well, I think vol is going to go up coming into earnings. That's a pretty easy basis play to make. But if you don't understand the nuances of how options actually behave, you then might actually see what you wanted to see, which again is this change. That's a big change. But this unfortunately doesn't account for your decreasing Vega and your exponentially increasing theta, which led to a net negative position. So this gets really, really nuanced as we go into different examples. This was literally just using vol, and I see that we're a little after 1800. So before I wrap up, are there any specific questions on what we just went through, on how these different factors influenced the P&L of your position, and how even though in this case, your implied volatility literally doubled effectively, going from 266 to 495, and that was the basis for the long straddle, how that still wasn't enough to outpace your aggressively expanding theta and the decreasing radius of your Vega. Fortunately, didn't get you to where you needed to be. So when we're making trade decisions based on this information, this proves a very, very important point, which is you don't have the luxury as an options trader of focusing on only the factor that you care about, whether that factor is delta, theta, gamma, vega, whichever those factors you might have a stronger opinion on or might care more about. Unfortunately, that ultimately doesn't matter. You have to pay attention to the entire ensemble. Reese says, I came away with don't buy strangles. That's actually the wrong thesis, to be honest with you. It's don't buy strangles, and in this case, specifically a straddle. Don't buy things indiscriminately coming into expiration. So if we were to go day by day on this and actually see when the biggest jump occurred, because you can see from April 23 to 25, you ate a pretty big change in your theta, no change in your vega, but then very little change in your IV. So this holding period here did not help you. But there's absolutely a holding period during this where you might come out net positive because of how much this vol starts to ramp compared to what you had. So the other takeaway is not just you can't be blindly buying vol coming into an earnings release, but you have to be pretty tactical with where you think that vol might really start to accelerate. If you're really enterprising as a trader, you can develop a system that measures the rate of change of vol to see when the parabolic element is starting to occur. How can we do that? We can go back to previous earnings cycles and we can look at the exact vols around those earnings cycles, and we can see when that vol change really became more parabolic in nature for the front. A good example of that, we can literally look at an example of that really fast. I actually think APP might have a good example of that because they just had earnings. Not that close. The 5th. Let's do something that had earnings a little nearer in time really fast. Let's do Dollar Tree. So if we look at Dollar Tree, and we take a look at their vol, and we look at their change in their front vol. Look at this. Their front vol goes from, on the 22nd of August, front vol goes from 34%, doubles to 62% on 28 August. Let's overlap price performance. I think this one's price performance, so we can tie these together. And then, well, actually, I'll do it on this chart so that you can see proximal. So this is 22 here. And then I said, what, 25? Here. So it essentially just went sideways for a weekend. And vol started to double there. Then vol goes from that doubling of 61 and it rallies to 116. It does that from 28 August to 2 set. So 28 is here. 2 is here. So let's take a look at that specific example really fast if we can. Let me see. The 28th to the 2nd. I just want to see if it actually gives us those dates. Bummer. It doesn't. We could do one that's a little further back so that you can see the same concept, but through. Let's do AEO. Oh, wait, no, that's this. Doesn't give me. Super annoying. All right, let's find something. BILL, that's a great one, or NTAP. Let's take a look at BILL. I want to see how their vol behaved so that you can see a full example of this, which looks like there is. When was their earnings? On the 27th? 7th? Yeah. Yeah, this is great. And it's funny because BILL actually also looks kind of haywire because of some event that it had on the 31st, whatever that was. So it had 27th. And it is after. Okay. So BILL really started to expand massively starting from the 15th. Let's go to the 15th. And I'm not going to bother like trying to structure any sort of like crazy trade. I just want you to pay attention to the vols. So this is, I'm going to use 7-day options, which is here. And we're just going to pretend that this is liquid, that this looks good, and yada, yada, yada. So our vol is 22 and 34 across these. So now let's go just straight to earnings, which I think we said was on the 27th. And I just want to show you how the vols change over that time frame. Oh, these only go to the 22 August. That's my bad. That was a silly choice. I needed to include the one that has. So in this case, earnings was on the 27th. So we need really like 14-day options, which is a little too long. So we'll put this trade on instead on the 20th. Yeah, this will give us a decent. So here, this is our at the month. What are our vols? 34 and 32. Okay. So now let's fast forward, go straight to earnings. We had 34 vols and 32. So now on earnings here, you have 48 vols and 43. Again, for the size of this thing, that's not some sort of parabolic move compared to what you saw in APP on a relative scale. But for something like this that has lower overall vols, which this is the wrong ticker. One where I was like, why is the fucking stock price so off? Go back here. These are your 59 delta BILL. Yeah, this looks way better. So in the example that we were looking at there, that actually is still another really good example of something that has lower vols, but even with those lower vols, as time had passed, you started to see those vols expand. Again, not huge, but pretty significant relative to itself. Because what did we have? 60 vols to start, and then we had like 85 vols, maybe it's like 65 vols to start. So we added 15 vols over the course of a week, and in that one, it didn't even have earnings. So this one, I absolutely would expect to see more. Now, these are starting at 127% vol and 123. This is us, again, coming into earnings. So remember 123 and 127. And we got in for what, 685. So these are now at 663. Well, again, we kind of have to go towards the mid. So about the same, which that in and of itself tells you a lot. Because for these to be effectively unchanged, coming through, holding for an entire week, as we know theta is getting really, really accelerated here, we know inherently that the vols had to have gone haywire. And they did, right? We had what, 123 or 132, whatever, dyslexia coming in. Now we're at 204 here and 240 here. So the vols absolutely started skyrocketing. And this is a fantastic example of how vols are actually reasonably priced coming into earnings if your timing isn't really, really good. So a lot of times when I cite those studies for trading earnings and I say things like vols tend to start expanding about 2 weeks out, you can choose to begin your trade about 2 weeks out, and you can actually make money doing that, but you have to gamma scalp because you have to subsidize the holding cost of the theta. So gamma scalping in something like this would actually be quite profitable because you can see how from when we started on what, the 20th, we had plenty of price movement to gamma scalp on, plenty of price movement, which creates and generates positive P&L that you can then use to help offset your theta cost, which in this case would absolutely lead to a profitable position. So that is a general breakdown of how options actually make money. As always, if you have any questions, you can hit me up in the Discord. Be an outlier. See you guys later.